Welcome to Market Catalyst. I'm Julie Hyman. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, tariff threats rattle markets. We'll break down if the volatility is here to stay. Plus, we'll watch out for a potential ruling on the legality of the president's tariffs, what that might mean for investors. And we'll hone in on artificial intelligence as growing backlash hits the infrastructure buildout. All that and more coming up on Catalyst. So let's get a check on the markets here because we have to dig into what's going on today as President Trump is threatening tariffs on European allies in the spat over control of Greenland. Basically, he's saying to any nation, particularly in Europe, that doesn't support his quest to take over Greenland, he's going to impose a tariff of 10%, he says, that then will go up to 25%. Meanwhile, he and many of those global leaders that would be affected are in Davos, Switzerland, at the World Economic Forum, where most of the rhetoric that's early coming out is aimed at sort of reducing tension. So we'll see how it plays out. Markets right now are sharply lower, although they could be a lot lower still if indeed markets were really taking this seriously. There also is another factor to consider, and that's a sharp sell-off in Japanese bonds, which has also caused a ripple effect through the markets. All of that said, the Dow right now is down more than 700 points. The S&P 500 down about the same, about 1.4%. The Nasdaq down a little bit more, about 1.6% here. And let's talk about some of these different assets that are affected by all of this. If you take a look at treasuries here today, we are seeing a fairly substantial increase in treasury yields up to 4.29%, up about 6 basis points on the 10-year. And if you look at the 30-year, we're seeing a move of 8 basis points. So there were some headlines coming out that one Danish pension fund was selling off its holdings of U.S. treasuries, but sort of on a relative basis, this is not a huge move. It does highlight the concerns that if there was a broader sell-off of U.S. treasuries, that could then create more of an issue. But something to keep an eye on right now. Doesn't seem to be that much of an issue. Here's the U.S. dollar, Japanese yen. Right now, not seeing much change. But again, we did see a movement in Japanese bonds. And then we've got people looking for safety here today. That is sending gold futures pretty sharply higher and is especially sending silver futures sharply higher, a gain of more than 7% today. So big ripple effect happening throughout asset classes from President Trump's renewed rhetoric here. And then you've got those sectors in the S&P 500, mostly in the red, except energy. We do have oil prices that are rising today, so that's sending energy stocks up as well. Consumer discretionary, real estate, and tech are the three worst performing groups here. And we do have a sell-off that's been going on mostly in big tech as well. You got a few little spurts of green on the screen, including Netflix, which did convert its bid for Warner Brothers Discovery to all cash as expected. But otherwise, here, pretty sharp sell-off. NVIDIA standing out there with a decline of more than 3%. So with these geopolitical tensions rising between the U.S. and Europe, Wall Street is growing cautious on European companies. Here to discuss all this and more, Novo Capital managing partner Ben Harburg. Ben, you're a venture capitalist, investor globally, right? And not just in tech, but in sports teams as well. So in other words, you've got a pretty diverse portfolio. And I'm curious how closely you're watching this increase in geopolitical tensions and whether it affects what you invest in.
It certainly does. I mean, I think today you need a degree in international relations rather than economics, or let alone the ability to dissect a balance sheet to navigate a lot of the turbulence. We've spent a lot of time in Asia, which in some ways has been hurt a lot by the geopolitical turbulence, particularly that between the United States and China, but now feels a little bit more of a safe zone as the president turns his attention more towards Europe. Europe was never a major target for us because we like emerging markets. We're here in the Middle East today. We like East Asia, Southeast Asia. And so we've targeted more what we would call kind of the next billion consumers rather than kind of yesterday's consumers, particularly those based in Europe.
Ben, do you worry at all that at some point the president's attention will turn? I mean, Venezuela is an emerging market, for example. Do you worry that his attention will turn to Asian emerging markets at some point? Or can you not sort of operate that way? You just have to kind of go where you see the opportunities.
Well, I think China is kind of in its own parallel universe as it pertains to innovation, particularly around AI, core technology, hardware. And I think actually a lot of the risk that, people were pricing into China geopolitics is subsided significantly with very constructive dialogue between the president and his counterpart Xi Jinping. We always knew that this was a much more pragmatic, business-oriented president that wasn't as concerned with the intractable issues around China. And so I actually think and the Chinese themselves are very much prone to wanting to get a deal done. So I think that there's less geopolitical risk in that relationship, and there's more, frankly, in Europe, where there's a lot of pride and still a lot of unresolved hot wars and conflict that come into bear when you're trying to kind of balance European geopolitics with business opportunities.
So Ben, I mentioned you're also, and you said you're a tech investor. You invest in a lot of startups. And given your involvement in Asian markets, I'm curious how you think about the sort of AI arms race, if you will. There has been a lot of ink spilled, a lot of air expelled around this issue. What do you think in terms of the competitiveness between the US and China on that front?
It's very much neck and neck. I think, the expectation is that by the end of this year, early next, we hit AGI. And I think that both, economies are now significantly decoupled and technology ecosystems are significantly decoupled. And so, you now have Chinese chip companies, of course, a whole parallel universe of Chinese hardware, Chinese LLMs. And so, and to some degree, there's more American dependence on Chinese outputs, be it human talent or rare earth magnets, you name it. And so I think the Chinese have actually sufficiently decoupled from the US where, they still need the highest end NVIDIA chips, but more and more so they're breaking down kind of nanometer barriers on their chips. But the U.S. still depends on a lot of these, which I think is, again, one of the forces that's bringing the two economies to the table and really makes it so that decoupling is never truly feasible. But I think that, China is going to weather this storm relatively well because they've made it a whole country effort to design out U.S. products from their supply chain to enable their technology giants to grow in almost a Galapagos format parallel from the United States.
Ben, have you found that your capital as an American is any less welcome in the Chinese market?
American capital it's really the opposite. Obviously, there's been more barriers from the U.S. side restricting U.S. capital into China. China always had kind of what we call sensitive industries that were only ever allowed to be invested by RMB denominated funds, which we are not. And so it was more of an outbound investment restriction than inbound from the Chinese. But again, those two capital universes, I think, are now very much decoupled and separate. And so there's just many fewer US dollars flowing into China. And it's more the geopolitical swing states that are taking advantage now of that capital market decoupling.
And Ben, as you look ahead here to 26 and 27 for that matter, you talked a little bit geographically about where you're seeing opportunities. I'm curious sort of, in subsectors or particular technologies, what are you finding most exciting right now?
Well, obviously, our view is that the impact of AI across the entire work stack and consumer value chain is going to be much more pronounced than perhaps people are willing to admit. And that will cause significant job displacement. But of course, that means also that the companies that are integrating AI into their entire workflow, be it scientific, biotechnology, enterprise, are going to be great beneficiaries here. And so on the one hand, there's been obviously a theme that there's a bit of an AI bubble. And I do think that the AI kind of mega companies perhaps need fewer chips than has been headlined, less energy. For instance, I don't think I'd want to actually be in the data center space right now or the power space. But I do think that the downstream applications, again, across the world, and particularly in the United States and China, are where a lot of the excitement lies today. And then dealing with all of that job displacement, how do we ensure those people are leading productive lives and still fully integrated into society? that will provide, I think, interesting opportunities as well. And that's why sport is interesting to us, because we think sport is very much recession proof. It is decoupled from the rest of the economic cycle, and in that regard, it's kind of a contrarian play on everything we see around us.
I'm glad you brought up sport, because I wanted to ask you about that as well. You are a chairman, and you founded something called the Harburg Group, which has ownership of soccer teams, particularly in the Mideast. I'm curious about prediction markets there. Have we seen prediction markets break in there, and has that increased sort of fan engagement at all, like we've seen it to some extent happen here?
Not as much. Obviously, gambling of all sorts is outlawed, particularly here in the GCC, and I guess now the UAE will start to legalize it, but certainly not here in Saudi Arabia. I'm sure it happens offshore, but it's not something that it trickles its way in. But this is still very much an authentic football fan market. Over 75% of Saudis would kind of declare themselves football or soccer fans. So the sport really has a monopoly on the market. It's where all eyeballs are tied for match day. The national team is a source of pride and also sometimes tribulation. But it is very much more about the increased monetization around the sport, be it game day revenues, merchandising, sponsorship, TV revenue, than prediction markets or gambling.
Gotcha, 75%. That is indeed a big number. Ben, thank you so much. Appreciate it.
Thanks for having me.
Coming up, what's next for the Clarity Act and the crypto industry after the Senate's canceled vote? Progress on the Clarity Act, that's Congress's cryptocurrency regulation, was stalled last week after Coinbase CEO Brian Armstrong withdrew his support of the bill. My next guest says the bill is crucial to the crypto industry and that time may be running out for lawmakers to reach an agreement. That is Mark Palmer, Benchmark Company Managing Director and Senior Research Analyst. Mark, it's good to see you. So the Clarity Act is sort of the pipes around regulation, sort of the nitty-gritty of how cryptocurrencies, how stablecoins, how tokenization is going to be regulated. What, in your view, needs to happen to get this thing over the finish line?
Yes, well, this is an absolutely critical bill in terms of creating the rules of the road for the crypto space, so that institutional investors who have been reluctant to get involved because of the lack of those rules can do so in earnest. And that really represents the next leg up for the crypto space in terms of the growth of the ecosystem, crypto prices, the support for all of the different crypto companies that have come onto the market. The single biggest point of contention with regard to the bill has to do with yield and interest on stablecoins. Stablecoins, of course, are backed on a one-to-one basis by US dollars. They are used for payments, for money transfers, for settlement. But the Genius Act, which was passed last June, said that there could not be any yield or interest on stablecoins, but there was a bit of a loophole where third parties, such as a Coinbase, could offer yield on those stablecoins. Now the banking lobby, which is seeing this as a threat to commercial deposits, is going after that provision, wants to make sure that even third parties are not able to offer those sorts of yields. And so that's where we are right now, trying to find a compromise between the banks on the one side and the crypto entities that would benefit from being able to offer yield on stablecoins on the other.
And Mark, just to make sure I understand this, so stablecoins are backed one-to-one with the dollar, and they're backed because companies like a Circle own U.S. Treasuries, which are yield-producing instruments. So is the idea that they would pay out some portion of that yield to stablecoin holders?
Yes, that's the way that things work in essence with a company like Coinbase. If you own USDC stablecoins through Coinbase, you can earn a yield of 3.5%, which of course is much more favorable than the tiny amounts of interest that can be earned in commercial deposits in banks. As such, the banking lobby has said that $6 trillion of U.S. commercial deposits would be at risk, simply because consumers, seeing that they could earn 3.5% and more on stablecoins, would go in that direction. That would suck deposits out of the banking system and ultimately curtail commercial lending and the other means through which banks help to support the economy. That $6 trillion figure comes from a Treasury study. It seems a bit of an exaggeration in our view, simply because most stablecoin usage, again, comes down to payments, money transfers, and the like. But it's clear that the banks see this as a threat. There could well be a compromise here because there are other ways that crypto platforms can generate revenue from stablecoins, particularly by providing what is equivalent to yield or rewards to their customers. One is through staking, which is the means through which new cryptocurrencies are created through proof of stake algorithms, protocols. And another would be by providing liquidity to decentralized finance or DeFi protocols. Either way, there would be the equivalent of yield generated in terms of reward. So there is another way that the crypto platforms can provide a means of attracting and retaining customers on their platforms without offering interest. That may be where this all shakes out at the end.
Mark, does this, if the bill is going to get through, does it need to get through in the first half of this year? In other words, does getting closer to the midterms imperil any progress on this?
I don't know how you couldn't reach that conclusion that, the closer we get to the midterms, the more likely it is that any sort of major legislation is unlikely to be enacted. For those who are taking a different view with regard to this bill, they don't necessarily want to see the crypto infrastructure built out the way that the bill is proposing, waiting until the Democrats have more power in the House, potentially in the Senate, would create more leverage in that regard. And the ultimate form of the bill, may look quite different than it would if it were to pass at this point. So the closer we get to those midterms, the less likely this is to occur. I think, it's really the next couple of weeks are going to be telling, as we get close to the potential markups of the bill, both in the Senate Banking and Agriculture committees. That should give us a sense of where we stand at that point. But behind the scenes right now, there's a tremendous amount of activity trying to iron out compromises with regard to some of these sticking points.
And just quickly, Mark, which of the stocks that you cover has the most to gain and lose from this bill, whether it goes through or not?
Well, in terms of gaining, I would point to a couple of stocks in particular. One is Galaxy Digital, because as I said earlier, the bill really is about creating a green light for institutional investors to get involved in the space. Galaxy Digital has spent the last 8 years building a state-of-the-art platform designed to facilitate trading of crypto for institutional investors. And so it has attracted quite a bit of business to its derivatives platform, its lending platform, but with regulatory framework in place, its volumes should increase dramatically. The other company, which I mentioned before, is Coinbase Global, which again has a robust infrastructure platform for institutions. It's not the entire business. A lot of Coinbase's revenue, the majority of it at this point, is generated on the retail side of things. But the future of Coinbase really depends a lot on institutions continuing to get involved in crypto. And so those two names, I believe, are the two that would be most directly impacted by the enactment of this bill.
All right, we'll be watching them and the progress or lack thereof of the bill. Mark, thanks a lot. Appreciate it.
Thank you.
Coming up next, we've got your calls of the day, and we'll discuss Greenland and the implications for U.S. manufacturing of President Trump's policies.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching Logitech, Intel, and Brinker. First up, let's take a look at hardware stocks like Logitech, NetApp, and Dell, because Morgan Stanley downgraded the sector, warning that companies could sharply cut spending as the, quote, perfect storm of slowing demand, input cost inflation, and rich valuations emerges. That led the firm's industry view to turn cautious from in line. Next up, Intel, HSBC upgraded its rating to hold, citing stronger server CPU demand tied to agentic AI. The stock also got upgraded to buy from neutral at Seaform, citing an improving outlook for its foundry business, that's at Seaport rather. There are currently 9 buy ratings, 36 holds, and 7 sells on the street. Last up, Brinker International, ticker symbol EAT, EAT. It's the company behind Chili's. That stock in the green against this backdrop of red after TD Cowen initiated coverage on the company with a buy rating. The analyst there, Andrew Charles, called it a, quote, undervalued growth story within casual dining. The reason behind that call? Well, the success of Chili's. In a note to client, he said that the firm's conviction is informed by steady improvement in Chili's value and quality perceptions, especially among younger consumers, with headroom to grow. The stock is pretty well liked on the street, has 15 buy ratings, 8 holds, and no sells. Keep it right here on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the session.
President Trump is doubling down on his push to take control of Greenland, escalating rhetoric just as world leaders gather in Davos. For more, we're bringing in Scott Lincecum, Cato Institute Vice President. Scott, thanks for being here. And I know that you have been sort of laser focused on tariff policy and the tariff impacts on the U.S. economy. So obviously we have a new tariff threat, but it's sort of a different kind of tariff threat. And I'm curious what you make of it and what you think the outcome is going to be.
Well, you always, with Trump tariff threats, have to wait to actually see a official legal document. So I think, for now, we are in wait and see mode to see the timing and whether it even actually happens, the legal justifications as well. With the Supreme Court ruling sometime in the next few weeks or months about Trump's emergency tariffs that will potentially conflict with these new tariffs again, if we ever see them. I think the bigger takeaway here, though, is about the effect of tariffs and tariff uncertainty on the U.S. and global economies. If you listen to businesses last year, particularly American manufacturers, a lot of them said, hey, look, we can deal with the tariffs, but it is the uncertainty. It is not knowing what the tariffs rates are going to be in a week or a month that's really killing us. And I think this Greenland drama really hits home that, contrary to a lot of analyst predictions, 2026 is still going to see a lot of this stuff going forward, whether it's on Greenland or anything else.
Well, and Scott, we just learned a little while ago that we are not going to get a Supreme Court ruling on tariffs today. But that's also another sort of element of volatility in this whole situation, because we've heard from the administration that even if the Supreme Court overrules some of the tariffs, that they have sort of backup plans to reinstitute them.
Yeah, exactly. The Supreme Court decision is important for a lot of reasons, but more on the executive power side than really on the tariff rate side, because the administration has other laws at its disposal that'll let it effectively recreate its global tariff regime just in slightly different ways. Now, that might give us a little more notice. It might put a little more structure on these tariffs, but it's not going to change overall tariff rates much, and it's certainly not going to end this uncertainty. And I think as well, the complexity of all of this, because you're not talking about one flat tariff rate on all goods. You're talking about wildly different tariff rates by country, by product, by content. And then, of course, there are exclusions and new deals, and then Trump trade truth social posts. Put it all together, and it's just a brutal business environment, particularly for American manufacturers that are deeply enmeshed in these global supply chains.
I want to get more into manufacturers, but first I want to ask you this, Scott. I mean, the Trump administration itself, and a lot of investors we talk to would say, get over it. The U.S. economy is in great shape. markets are in great shape. Corporate profits are in great shape, even with this difficulty and volatility you're talking about. So where's the problem?
Well, with a lot of this stuff, it's always what could have been. There's no doubt that AI, the tax bill, and some of the new corporate tax provisions, easing monetary policy are providing real tailwinds for the U.S. economy. And I think other Trump deregulatory provisions are also helping. But the issue is that the tariffs are just hurting a little bit. They're just taking a little bit off of investment and output and other things. So things could be even better if they weren't causing these own goals. And then, of course, you got to remember that beyond the macro level, you're talking about a lot of businesses, particularly smaller businesses, that are really struggling in this tariff environment. And those types of pains, I think they get washed out by all the macro obsessions, but they're real. And, with bankruptcies going up last year and other things, they're starting to bite.
Well, I want to talk a little bit more about the goal of the tariffs, right? We're now 1 year into Trump's second term as president, and one of his explicit goals for the tariffs was this renaissance in American manufacturing, right? And here we are, and it certainly hasn't materialized yet. And I'm curious if and when you think it is going to materialize.
Yeah, like I said, there are some of those tailwinds that should push manufacturing forward this year. It does appear that we're in a kind of an upward trend in the business cycle generally. But the reality is that American manufacturing is very much global. About half of everything imported into the United States are industrial inputs. So the things that American manufacturers need to make other stuff and stay globally competitive. Combined that, so the additional tax expense and higher prices for steel, aluminum, and metals, you combine that with all of the uncertainty, and what you've seen is a manufacturing sector so far that's just kind of stuck in neutral. It's hemorrhaging some jobs, but job openings are down generally. Output is up a bit, but really not doing much. The soft data from these surveys are pessimistic and have been for the year. And that just reflects the fact that, when you throw a bunch of this tariff sand in the gears of these finely tuned supply chains, it doesn't mean it's going to be catastrophic, but you're not seeing a boom. And I would expect this year similar types of fits and starts to continue.
What would change that? If assuming that the tariffs are not going anywhere, is there anything else that would change or improve that picture?
Yeah, you would need to see a pretty radical decrease in the uncertainty of all of it. If you actually could get to a situation where tariff rates are relatively uniform and transparent, and they're not changing every week or month, and some of that complexity gets ironed out, and businesses are allowed to have a consistent and predictable environment for their business, for their sales, for their supplies, then you might be able to see those tailwinds really push the sector forward. But unfortunately, that just seems highly unlikely, particularly with the president's love of threatening people with tariffs and with all of those laws, including the ones the Supreme Court is looking at, that allow the president to effectively flip tariffs on and off like a light switch in the Oval Office.
He is tariff man after all, Scott, as we know. Thank you so much. Interesting perspective on all of this. Appreciate it. Coming up, with Netflix confirming its all-cash bid for Warner Brothers, what to watch when the streaming giant reports earnings. That's next. The battle for Warner Brothers Discovery continues to heat up as Netflix puts forward an all-cash bid for the company. I recently sat down with Rich Greenfield of Lightshed Partners to discuss what he thinks will ultimately happen with that bidding war.
Moving to an all-cash bid, which hasn't happened yet, but, wouldn't surprise me. Netflix reports Tuesday after the close. It wouldn't be surprising that sort of ahead of or tied to earnings if they make this adjustment. They're not doing it. I don't really believe they're doing it because their stock is modestly below the collar, which would mean that the overall bid is 30, 40 cents light from what they said originally. I think this is about timing. Paramount has talked about the fact that they think they can get regulatory approval far faster than Netflix. Now, whether that's true or not, when you think about states and foreign markets, like there is still a lot that we don't know in terms of the regulatory review process. But in moving to all cash allows for a shareholder vote that could be in March versus a shareholder vote that would have probably have been in June. And so no one's going to have regulatory approval on this. It's not even possible to have March regulatory approval. So you sort of move that at least perceived by Paramount advantage, you take that off the table, and you basically put pressure on Paramount. If they're going to raise their bid, they've got to raise their bid sooner than later.
Okay, so if it does go to cash and it goes to a shareholder vote in March, Paramount has said they're going to take their bid to a shareholder vote also. If you were a shareholder, I mean, what's the most appealing outcome here?
I think the problem is right now with Paramount, again, assuming an all-cash bid, I think Paramount is in a tough place because with their bid where it is, the value of Discovery Global, I know Paramount has continued to say it's worthless. And remember, they need the split not to happen, because if the split happens, all of the cash flow that they need to finance this transaction disappears too. So mission critical for Paramount is to stop the split of Warner Brothers and Discovery Global. Discovery Global is spinning off. The board looks at that as a critical transaction because they want to get these cable networks off their books. They want to start chopping them up, selling CNN to someone, selling Food Network and HGTV. Like, they basically want to run an auction for the entire portfolio of assets. That's only possible if you get this split accomplished. And so I think unless Paramount meaningfully raises its bid, I don't think a couple of dollars does it. They have to meaningfully $4, $5, maybe even $6 raise the bid. And that's going to require a heck of a lot more cash that right now they don't appear to have, because I think if they had more cash, they would have already raised their bid.
So you came out with your predictions at the beginning of the year, and you said you thought the spin was going to happen. Netflix is ultimately going to win, but it won't close this year. They won't get regulatory approval. Has anything happened to change that view?
No, I mean, look, I think that is what we believe. And look, there's always the outside possibility. Larry Ellison is one of the world's richest people. Instead of putting $12 billion into this, could he put 40, 50, 60 billion of cash, dramatically delever Paramount, enable them to raise the bid, equitize the current bid? Sure, there is certainly that potential. There have been no signs throughout this entire process, if anything, going to get Middle East money, leveraging Paramount to 7 times at closing. There are certainly no signs yet that the Ellison family is willing to put far, far more capital in. And so that's why we still struggle to believe that Paramount wins. I know it feels like consensus on Wall Street that Paramount's going to come out with a knockout bid. It just hasn't happened, and it feels hard to see it happening right now.
Coming up, we'll get a read on the AI infrastructure build-out and growing backlash to the booming business. That's next on Market Catalysts. The artificial intelligence boom has led to a surge in demand for power, and with it, surging electricity prices. But there's growing opposition to AI data centers and the costs associated with their build-out. New data from intelligence platform Heatmap Pro shows at least 25 data center projects around the country were canceled last year due to opposition from local communities. That opposition stems from rising utility costs like electricity and water that these data centers require, and a majority of the cancellations are taking place in the Mid-Atlantic region. Joining us for more on this is Bob Clark. He's executive chairman of Clayco and founder of that company. Clayco is an engineering and construction firm that is playing a large role in the AI data center build-out. Bob, you guys have partnered with companies like Galaxy and AWS on some of these build-outs. It's great to have you here, and you're coming to us actually from a conference of some of these data center providers. Is there talk about this backlash that we have seen, and what effect is it having, if any, on some of these projects?
Yeah, good morning, Julie. Thanks for having me today. There's a lot of talk about the backlash. It's definitely one of the top topics that everybody is addressing. And I think that one of the things that we're learning from our partners at Microsoft and AWS is that they are really leaning into a much better communication strategy. I think that's what most of the buzz is here, is that all of us in the space have to do a better job of communicating what the real facts are. What we're learning from our entitlement processes, where we're in town hall meetings, listening to the community members who are worried about their electric bills going up is that the facts prevail. Our projects do get approved when there's rational discussions, and it's a ground game that includes meetings in people's living rooms, talking to them about what the reality is. Utility bills have gone up, 25% over the last 5 years, not because of data centers, but because the grid is outdated and wildfires and all kinds of other things have caused the industry to have to realign the grid. And quite frankly, we have to upgrade our power in the US for a long-term view. But I think most of the utility companies are addressing the neighborhood concerns by telling them that the home utility bill will not be impacted by the data center construction. And President Trump weighed in even as recently as a week ago or so. We all agree that people's home utility bills should not go up because of data centers. And Microsoft and AWS have said they're going to pay their fair share or more.
Well, Bob, I mean, it seems to me, talking to some utility and power experts, that at least some of the increase in electricity partners to date has been from existing data centers or ones that are, had gotten put on the grid before now. But it seems like that there is this push on the part of the big hyperscalers to your point, to shoulder a lot of that cost. Or do you think going forward that that's just the cost of doing business, that they're going to shoulder the cost of any increases in electricity or water for that matter?
Well, hopefully there will be a boom in advanced manufacturing and new onshoring of manufacturing during this administration. That's what the hope is, I think. And all of that will cause, the utility companies to have to power up and to realign their grid. And, we're hopeful as a builder to be, building more car plants in the US, more battery plants, more battery storage. So it won't just be data centers. Data centers are a big user of the power, but hopefully, we want a boom of manufacturing and new business across the United States, real job creators, and it won't just be the data centers as the kind of boogeyman. I think, as I said before, I've really been impressed with the hyperscalers' recent move into this argument to say that they're going to pay their fair share. They're signing long-term power agreements with the utility companies, which I think will strengthen both the grid and the power availability over the next 20 to 25 years. And again, I think it's having rational conversations with people across the spectrum in these town hall meetings. And when people really hear the facts, which are the driving thing that I think people have a misunderstanding about, is the job creation of these data center projects in the communities, which are vast, long-term, game-changing kind of labor numbers in these communities. And when people really learn and hear, the amount of dollars that go into payroll over the life of these data center campus construction projects, I mean, it's game-changing for their revenue streams, for their restaurants, their gas stations, their retailers. And then the long-term revenue is a game changer for their hospitals, their fire departments, and their personal security with their police departments. So again, we've been winning the battle, but it's a ground game, and we need everybody to be transparent. The hyperscalers, the developers, and everybody has to step up their communication game. I believe it's more of a communication problem.
Right.
And we all have to do a better job.
Bob, the projects that have gotten canceled that we mentioned at the top there, are they being moved to other places? Have you been seeing that happening? And if so, I would imagine that it takes a while, right? You got to do the permitting and site surveying and all of the groundwork. So
I believe a couple things. I believe some of those projects will go back and get approved. I think, again, people have to hear what's in it for them. They have to understand what the reality is instead of the NIMBYs have gotten very organized and are doing a really good job of spinning, what I think is a lot of misinformation. Like the what's in it for me is very beneficial to these communities when they really see the dollars and the people are trying to attract other types of manufacturing into their communities, or casinos, or other revenue generators because they all have busts in their budget. When they really learn what a data center can do, a data center campus, like in Quincy, Washington, as an example, I mean, the place has brand new schools. The place has an amazing fire district. And all of that is because of the data center boom that came to their town. And it's, still has a small town feel. So,
and Bob, I am curious on the job front, because Quincy is an interesting example. They have a bunch of data centers too, so they've definitely gotten that influx of capital for municipal purposes. And you guys come in, and it seems to me that most of the job creation happens in the construction process, right? Like a data center itself doesn't employ that many people, right? Is it a matter of the capital coming in?
No, I think that's a misconception. First of all, they take 4 or 5 years. The labor goes on, and you're talking about a data center campus that may have 1,500 to 2,000 workers who are making over $100,000. Some of the electricians today are making $185,000 a year. A lot of those are local people from those communities. I know in particular, our big hyperscaler clients are doing a lot of community outreach. We're doing apprenticeship programs, and we're bringing people into the trades that have never contemplated being in the trades before. But after we're finished with a data center, there's still retooling of the data centers. It's like the car plants. When we build a car plant, we actually never leave because there's constant updating, there's constant retooling, there's replacing the servers. So while they say they may be 100 full-time technician jobs, there's another 300 or 400 jobs that are generated by a large-scale data center in the community. And if you look at Quincy as an example, we at Clayco have done, I don't know, probably several $1 billion worth of construction in that town over the last 7 or 8 years. It's been a constant labor driver into their community. And now there are really significant number of permanent jobs in those data centers. So I think that, again, this is getting in people's living rooms and in the town hall meetings and setting the record straight on the job creation front.
Bob, thank you so much for being here. And obviously you're trying to make some progress on that communication front. Appreciate it.
Exactly. Thank you, Julie. Good to see you.
Take care. You too. That's it for Market Catalyst.